if you invested your stimulus check into Tesla last year when you got it, that investment would be worth around $7,000 today. What's up guys, Jules here, and today I just want to give you guys an introduction to the stock market. I'm going to be answering a couple of questions for you guys, like what is the stock market exactly, how does it work, why you should invest in the first place, why should you do this, what's the point, what are the risks involved, which I know is a big concern and fear that a lot of people who haven't done this or don't know anything about it is going to ask, so I want to address those risks, and how to get started. Basically, I just want to point you guys in the direction of how to get started by the end of the video, and then I'll expand upon that later on. But this is just a very introductory video. So what exactly is the stock market? It's exactly what it sounds like. It's a marketplace where you can invest money into pieces of companies. So a share or a stock or a security, those are assets, right? The same way a car is an asset, a house is an asset. The stock market is a mechanism for you to invest into pieces of companies, and as those companies do well and their profits grow and their income grows, the money that you put in also grows by a certain percentage. Same thing, if they go bankrupt or bad news comes out, the company starts doing poorly and incurs a lot of debt, the money that you've put in starts depreciating in value. An example of this is if you like Apple as a company and you trust the company and you think they're going to keep growing in the future, then you would buy a share of Apple. And if the company continues to do that, the $100 that you put in is going to grow over the years and over the months. And you guys have probably seen this meme all over, stonks only go up, right? So this has become a very popular meme. I just thought it was funny until I started learning about it, and turns out stonks only do go up pretty much. So it is a meme, there is some truth to it, but we're going to talk more, especially in the future, about this whole deal, bear markets, bull markets, stuff like that, and why everybody thinks they're so good in a bull market, and why that may or may not be the case. 2020 was a very good year for me, at least just in terms of stock market stuff. I've been able to double what I've put into the market so far, but that's abnormal. 2020 was a very historical year, so you can't expect every year to be like that, guys, just as a reference. All right, so why should you invest in the stock market? This is a very good question. So if you look here, on average, the stock market returns about 10% per year in the last century. There's a lot of data that people have taken of every single year that the stock market's been around. On average, the stock market has returned 10% per year on investments, right? And I've heard figures, that are a little bit more conservative, say 7% a year. I think that's pretty much the agreed upon average rate of return, right? So if you put your money in the bank and let it sit there, what happens? It grows by 1% a year if you're lucky, in a savings account. Annual rate of inflation is 1.4%. So you're actually losing 0.4% on your money each year. So in general, the stock market is just a better place to potentially grow your money or grow your investments. Just as an important disclaimer, I am not a financial advisor, and nothing that I say in this video should be taken as financial advice. This is just my opinion and me pulling things together from the internet to help paint a broader perspective for you guys. So please don't risk anything that you cannot afford to lose. I'm not a financial advisor. This is your disclaimer. So in general, the stock market is generally better than putting your money in a savings account with a bank. Is it better than a Roth IRA or a non-taxable holding fund? Those are different questions that I'm not going to get into right now. It's a way to grow generational wealth. It's a way that most people, when they make money, this is what they do with it. They diversify, right? They'll buy real estate, they buy land, they invest in other companies, and they buy stocks, bonds, and ETFs. So this is just a mechanism to grow your money. Diversification of assets. It means that, if you put all your money into real estate and then the housing market crashes like in 2008, well, a lot of your money is going to be, lower in value or tied up that you can't really take out. It's going to lose a lot of value. But if you have, half your money in real estate, half your money in stocks, and then one of the stock market crashes, well, you still have real estate. Real estate crashes, well, you still have your stock market, right? Having a diversification of your assets is important for staying safe and managing your risk. This is just another chart showing the rate of return each year from the US stock market. As you can see, most of the years are green. You're getting a pretty decent return on your money. We got some red years, 2008 when the housing market crashed and there was a recession. But in general, and we are due for a big correction, but that's neither here nor there. In general, the stock market is a good place on average to put your money. According to Benzinga, if you invested $1,000 in Apple the day that the iPhone came out, your investment would be worth about $30,000 today. If you invested your stimulus check into Tesla last year when you got it, that investment would be worth around $7,000 today. I just want to give you guys more realistic examples so you can see that it's not, out of the ordinary, and it is, relevant to today's time to grow your money. We do have to talk about the risks involved in this. What are the risks? Well, if the stock market crashes, let's say you put your life savings into the stock market tomorrow and it crashes, it just goes rock bottom. That's a risk. That money, now you really shouldn't touch for a long time until the market corrects itself. But what if you have a family emergency? What if you have a medical emergency and you need some extra money on the side now to, survive or to save yourself? The money that's now in the stock market just got devalued super hard, and that is a risk. There is risk to, things could crash, and if you sell when it crashes, you just lost a ton of money. If you hold and do not sell and just wait for things to pick back up, it might take a couple of months, it might take a couple of years for things to pick back up. But if you just leave the money there, don't touch it. Historically, in the last century, the market always does bounce back to its original point and continues going further. So you will never really lose the money unless you panic and sell, but it's money that you really shouldn't touch for a long time if you're doing long-term investments. The risk is not having access to your money when you need it, as well as if things go down and you need the money desperately in that moment, well, now you're taking it out at a loss, right? Because you can't afford to just hold it in there and wait. So that's a big risk. Taxes are another risk. Whenever you sell, you have to pay taxes on any profit that you make. Some people don't know that, so they go and end up spending all the money, and then they have to pay a whole bunch of taxes later on. So I just want it to be known in general. But mainly it's due to poor management, fear, mistakes, and high-risk investments. The main risk is, like I said, just that things can crash, companies can go bankrupt. If you're investing in risky companies, maybe Apple will go bankrupt tomorrow, right? And then you will lose, or Google goes bankrupt tomorrow, right? Is it likely? Not really. Is it possible? Yes. There is risk, but historically there are ways to mitigate that risk and to do well. So how to get started? The first step is to educate yourself further. This is just very, very surface level stuff, very introductory. If you like the video so far, please give it a thumbs up. I'd greatly appreciate that. And consider subscribing to the channel for more content like this. I will be going deeper and deeper and more technical as my videos go on with these topics. First step to getting started is look up more information, get yourself educated, because you want to fully understand what you're getting involved into. The next step is to find a broker. A broker is basically a platform that allows you to buy and sell shares, right? So things like Robinhood, Webull, TD Ameritrade, Fidelity, Charles Schwab, right? So these are examples of different types of brokers, and they're all different. Some of them are more simple, some of them are a lot more complicated and technical, depending on your level of knowledge and comfort, how comfortable you are. I know a lot of people are going to give me heat in the comments for this, but I think that Robinhood is a fine brokerage to start on if you've never done anything like this before, and that it is, you're not going to be doing options or day trading with it. It's just going to be for long-term holding of shares. I think Robinhood's fine. You're welcome to disagree. If you want another alternative, Webull is fine for that matter as well. But I currently, right now, I use Robinhood, TD Ameritrade, and Webull, all for different things. And we're going to talk more about that. But basically, do your research, find a brokerage that works for you, that you enjoy. And then secondly, figure out how much you can spend. The money that you put into the stock market is supposed to be money that if I grabbed a lighter and burned it, you're not going to miss it tomorrow. You know what I mean? So, whether that's $50, $500, $1,000, doesn't matter. It's whatever you're comfortable with, not seeing or touching for maybe a couple of months or even a couple of years. So basically, figure out how much you can spend, how much your expenses are, your risk tolerance, stuff like that. Once you get signed up with a broker, all you have to do is connect your bank account, and you are ready to deposit money onto that brokerage account, and then you're ready to buy your first share. I suggested starting amounts. I mean, it's hard if you're living paycheck to paycheck. Even if it's just $50 a month that you're putting in, it will grow over time. I think a fine starting amount is anywhere from $100 to $1,000. It just really depends on your level of comfort. Anything less than that, I mean, ideally you can start with 500 or 1,000, but less than that, it's kind of going to be very small. Like, you're not really going to see a lot of change in the money. But, I think just starting in general is important. So figure out what that is for you. I started with just $500, and I was able to grow that in like 2-3 months. And then I started adding more and more and more, and just kind of growing and ramping it up from there. So start small, figure out what you're comfortable with. Also, TD Ameritrade offers a play money account where you can trade with fake money so that you can practice and learn the market, learn the skills. Not all brokerages offer play money accounts or fake money accounts, but some of them do. So if that's something that you're interested just to learn and practice, I would strongly recommend that, especially if you don't have money to spend, but you're interested in learning how this works and testing yourself. Anyways, guys, definitely, consider sticking around. I will be making more content revolved around this. And if you have any suggestions for what kind of videos you want to see from me regarding investing, real estate, or finances, or the stock market, please just leave me a comment. I'm very new to this, and I'm still figuring out how I want to structure my videos and what kind of content I want to make, and how it's gonna look and stuff like that. So it's gonna be rough around the edges for a little while, so bear with me, but definitely gonna be taking your guys' feedback into account. So I appreciate it. Thank you so much, and I will see you all next time.